Brilliant. Everybody, thank you so much for joining. You should be able to see my screen right now. I'm sharing with you my first screen, which is just euro-dollar. So euro-dollar has just taken a bit of a nosedive on the back of some of that German data. Let's just see what that was. There we go. We can look at this. Oh, not that. This in real time. German ZEW much weaker than expected. So hence why we're seeing euro really come off very, very sharply there, as you can see. Now, just one quick thing. I know that there's that you can ask questions. There's a chat box and a question and answer box. If I can just get you guys, if you have a question to ask, to put it in your chat, in the Q&A box, sorry, not in the chat box, that would be great. And then I'll make sure that I come to it and that we take a look at it. Now, let's just start looking, obviously start of a new week. Yesterday was a bit strange. UK was like half day. It wasn't particularly, a particularly strong day. It wasn't a particularly, high volume day. It was quite low volume. Tight ranges persisted for most of it. Risk overnight taken a bit of a nosedive actually, on the back of that kind of Eurogroup meeting that hasn't done anything. Added to that, we've also got, certainly didn't do anything new. Certainly hasn't given Greece any bailout funds, and almost pushed the can down the road yet again. With another meeting now on the 20th of November. It's all becoming a bit up in the air, really. Is Greece going to have enough money to pay its debts going forward? I believe yes. I believe that, fundamentally they will, and that what we're seeing is a reluctance on the behalf of the creditors to give Greece more money. However, I think there's an unwritten or unsaid acknowledgement that they will give Greece more money. They will not allow it to default this year, and Greece will not leave the currency bloc. So that's all. If there are, for now that seems to be the place that we're in, but that doesn't mean that we're going to be there forever. So on that note, I'm going to start by looking at euro-dollar. I'm not going to look at this chart. This is just the intraday chart. I'm going to look at the Ichimoku daily cloud chart. And as you can see here, let's just take a look. Look how close we are to the bottom of that cloud. Now, some of you will have joined this, my webinar last week, and we were in the middle of the cloud. It just shows, the last week or so, we've been in a prolonged downtrend whereby we entered the cloud. The minute we got through that 128.20 level, I think it was 128.80 back then, we have really just been on a prolonged downtrend, and that was a key break of resistance there. And right now, in the middle of the cloud, not trending, but the way that we are hurtling towards the support level at 126.50 is quite worrying for those bulls out, for those euro bulls out there. It's not looking good. That is my one. That's what I would say now. It's certainly not looking good for them. We are seeing we are seeing this 126.50 level acting as really tough support. Very, very sticky level for sure. However, right now I don't feel like we've put in a meaningful bottom. I think we are going to get below this, largely because I don't see any fundamental drivers that are going to stop us from doing this. On a technical basis, some of those longs that we've seen put on over the summer and over the autumn months are now being reversed. And that for me is technical momentum still to the downside. I also want to show you my other chart. Just bear with you a moment. You should be able to see it. Oh, sorry. Let's take a quick look at this. This is the daily chart on euro dollar. Just take a quick look. All looks a bit. This is the daily chart on euro dollar, as you can see here. Momentum very much to the downside. This is the RSI chart in front of you. Momentum to the downside, really nice downtrend there. It's really looking, if we break that 126.50 level, where do we go from here? 125 is going to be your next natural support level because it was a sticky level of resistance on the way up back in middle of August. So 125, I believe that if we breach 126.50, 125 is going to be the next level that we target. That is going to be the next support level of note. Obviously, that's a long way away. You know, we're 600 points away from that 120 level, so from those lows that we saw in July. But for us to kind of turn around and to get above 125, we're going to need to see, I think, some fundamental shift from the ECB, maybe that they're just going to start buying Spanish bond yields. I don't know. It doesn't look like we're going that way, and I just see us grinding lower. It's a continual grind lower, and that's what you're seeing in this very nice downtrend, a very, very nice downtrend, or break certainly, that we're seeing here. As I said, though, watch out for 126.50, likely to be very, very sticky. Same with 125. Now, as I said, I do believe that if we get any, I believe right now we could be in a bit of a mess. I'm going to go back to the Ichimoku cloud chart, because I kind of like it. As you can see here, I think that if we're to see any bounce of strength, maybe just you know, the downtrend that we've seen maybe pauses for breath for a bit, I think that any periods of strength will be sold into. So any move towards 127, maybe even towards 127.50, very much sold into. I think that's going to attract a lot. I think there's going to be a lot of people now thinking Greece is in trouble, Spain's in trouble, Portugal obviously. You know, there's a lot of stress there. And actually, what we could see, added to that, we've also got things in the US. There's a lot of event risk that could blow up right now, and there's a strong chance that we may have another flare-up of Eurozone sovereign concerns before the end of the year. Due to that, I think people are going to unwind their longs. They're going to look to potentially sell at better levels. So if we do see any rallies, they will be sold into in our view. Obviously, you know, right now we would look to sell on a better level. We do think this 126.50 level is going to be very, very sticky. If we do get below there, then we would look to establish a short. And that is because, you know, around these levels, they are support levels. Sometimes they can attract buying interest. We believe we're going to need to see some fundamental shift to attract buying interest and a reversal of trend at this stage, which we just don't see is happening. So this really is using fundamental and technical analysis together. This is kind of like a fusion theory, which you know, is key for the markets here right now. You know, you can't just look at one or the other. You've got to look at kind of the overall context when you're talking about euro dollar, because it's quite complicated. There's a lot going on, but also you can't ignore the technicals. I mean, the technicals are what are giving us the day-to-day, intraday, you know, buy-sell signals. They're all really important, and you'll be a better trader for looking at both at the moment. But definitely for keeping in mind this 126.50 level. Some of you may not know Ichimoku cloud, but basically above the cloud, uptrend, below the trend, below the cloud, downtrend, in the middle of the cloud, no trend really at all. We've already seen you know, some bearish indicators. So that's kind of a key thing there. Now the other pair I want to talk about is the pound. The pound, just bear with me one moment. We've seen a lot of volatility in the pound just now, and that was on the back of some slightly better than expected, much stronger than expected inflation data. Inflation rose more than twice what people were expecting for the month of October, and that was on the back of university tuition fees. So we saw a 0.5% monthly increase in inflation in October, which pushed the annual rate from 2.2% in September all the way to 2.7%. That is a massive drop. Inflation is going in the wrong way. Also, it's happened at an important time. Tomorrow is the inflation report for the UK, where the Bank of England presents their last inflation report of the year. Now, it wasn't that long ago that the Bank of England was looking for inflation to fall below target, so below 2%, through to by the end of 2012. Right now, it really doesn't look like we're going to go there. For obvious reasons. However, the rise in tuition fees is temporary. We're not expecting it to have a permanent increase in the report. So that is kind of worth watching there for sure. The other thing that we would point out as well is that today, obviously we've had that CPI data. We're likely to be very, very sticky. Now, I want to just look at the Ichimoku as well, because again, what we saw last week in the market was some real important movements. We saw the pound actually underperform the euro versus the dollar and fall below the cloud. So the cable rate, this is pound dollar, fell below the cloud. Now the 159 is the top of that cloud there, so it's the green line here that you can see in the chart. Anything below there is a technical downtrend. Now we have been jostling around a bit for sure. We've been kind of stuck in a very, very tight range since we fell through since we fell through the base of the cloud on Friday. But really, that incessant selling pressure over the last couple of weeks has led to some significant moves. That move below 159 in cable, that was a very bearish development for this pair. So we are bearish on the pound right now. However, let's just quickly go back to our cable chart, because as you can see, we've also got the We've also got a 200-day moving average here, which comes in around 158.50 to 60. That's acting as good support. So we're trading in a very, very tight range. One thing I would say is that we're not quite willing to sell cable at the moment, largely because we're not quite willing to sell cable right now, largely because of that inflation report. If there's a sign that they are moving away from QE, maybe they are also moving away from QE based on the inflation outlook. That could really cause gilt yields to spike higher, which should be positive for the pound. We need to wait to hear from that. I think that's going to maybe cause a little bit of repositioning. I believe that we're going to trade in a very tight range between now and the inflation report tomorrow at 10:30 London time, probably between 159 and 158.50. So that's the key thing. Now, I've got a question from Solomon. Kathleen, I find it hard to change my market sentiment. I became euro bullish in October when price broke above that 131. Human brain takes longer to change direction than the oil tracker. That is very, very true. Yes, the emotions of it, the belief in it, and that's why I said, sometimes you got to go with not just fundamental data, but also your technical data. So let's just take, just looking even at looking at the euro. I think the minute we got through that cloud, that was when I really changed my view. So I use technical parameters to kind of try and temper my own emotions, my own feelings, so that if, for example, I'm still bullish on euro and I think that, hey, this rally from the summer is going to last, the minute it went through the top of the daily cloud, so last week, that to me was, a very bearish development, and I use that trumped my own feelings. So that's what I mean when I say, use your fundamental indicators. Obviously have your view. That's what makes trading fun and intellectually stimulating. But also make sure you use your technical indicators, because that's going to really, you can't just go out there on your own and just have a hunch, because you've got a $4 trillion a day market against you. A technical analysis tells you what the market is thinking, and you need to sometimes go with what the market is thinking, especially when you're a retail trader. You can, of course, be contrarian. That is a key thing. Some people will be. But don't be contrarian and lose your profits. If you're still contrarian, you still think that the euro is going to break above, you're going to get back to kind of 135. Right now, you're losing a lot of money. And sometimes the best thing to do is cut out of your losing trades and maybe not trade that cross for a while. Take a look at what's going on to just keep your emotions at bay. There's sometimes nothing wrong with not trading. Okay, there really isn't. I mean, you don't want to do that for a long time. Of course, you want to be involved in the market. But if you've made a wrong call, then just step outside of the market. Look for something else. Just because you're not trading euro anymore doesn't mean you can't trade something else. Maybe trade the pound. If we get a break, for example, 158.60 to 158.50, I'd be looking to short the pound. That is below the cloud and below the 200-day moving average. Incredibly bearish signals screaming out for further declines. Now, the other thing that we have to ask ourselves are, obviously, the pound and the euro are weak. But how strong is the dollar? And for that, I'm going to just take a quick look at the dollar index. And I know, bear with me. I know some of you don't see the dollar index, don't have it. We don't offer it. But it's just what I like looking at the dollar index for is because it's a really good overview of the dollar. So you get to see kind of how the dollar is doing against all of its trading partners. Now, what we saw You know, a couple of weeks ago we saw it really breach that 200-day moving average. So really, you know, it was looking pretty like it was going to breach that 200-day moving average at 80.75. However, that managed to hold, and we've since moved higher. Now, if we get above 81.20, which is the 100-day moving average here in the dollar index, so if we get above 81.20 today, currently really close to that level, again, a very bullish development for this cross, which could lead us back towards 82, maybe even then to those 83 highs which we last saw in mid-August. I would be looking at what the dollar is doing. Because again, it's not just about what the pound is doing. It's also and the euro is doing. It's also about well, how strong is the dollar? How long can it last? Well, right now the market's getting pretty bullish on the dollar, especially if we breach this 81.20 level, then I would say that we could see another leg higher in the dollar, which could then weigh on cable, weigh on euro dollar, weigh on the other dollar crosses. So do watch out for that 81.20 in the dollar index. If we break above there. Remember, we do talk about the dollar index. So follow us on Twitter, Forex.com, to get the up-to-date information about that. The other another cross I want to take a quick look at, let me just take a look up here, is the Aussie. And the reason why, I mean, the Aussie has just been trading kind of sideways, but with a bit of a bullish bias. Let's just take a look at the Ichimoku as well, because it's not done nearly as badly as some would have thought. So it's managed to hold above the top of the cloud. However, the cloud is narrowing, which suggests that we're not really having there is no real prevailing trend in Aussie at the moment. Instead, what we're seeing, maybe a bit of sideways action. Remember, in the Aussie, we've got the interest rate differential, which is positive. We also had the RBA not cut rates at their last meeting at the beginning of this month. We've seen signs that China is picking up. So no wonder people might be a bit wary about selling the Aussie at the moment. Very, very good support there, 103.90. However, we are getting thwarted. The bulls are getting thwarted at 104.30 today. We're currently back above 104.10. I wouldn't be surprised if, you know, until we, you know, get some real direction in the event of a big flare up in the eurozone crisis maybe, or a big bout of risk aversion, we could easily turn around from here and trend lower. However, what we could see as well is actually a move higher. What we could see potentially is that, you know, a bit of a kind of move sideways without, and obviously a lot of that will depend again on the pound on the dollar as well. Sorry, not the pound, the dollar, and that is because, you know, we're looking at, you know, what the dollar can do. You know, will it get above that 81.20 level like we just saw? If it does, then that's going to really thwart Aussie gains, because remember the way that the FX works, it's all like kind of fractions. So if the dollar is strong against certain pairs, it's probably going to see that strength build across pairs. So, you know, as we stand right now, the euro is weak, the pound is weak, the Aussie is fairly neutral, the dollar is strong, and the yen is strong. And that brings me on to my next cross, which is dollar yen. As you can see here, dollar yen really turned around, and this is what risk. This is a sign again of very you know, low risk sentiment. Really, we are not you know, we're not seeing, you know, risk sentiment has been weak, and that's even weighing on the dollar against the yen. So even though the yen, the Japanese economy is looking very, very weak, we're still seeing influxes in there. Now we have got very good support here at 79. We think that should probably hold in this cross. So maybe potentially some downside in dollar yen could be on the cards. And we could see, you know, especially if we can manage to sustain those gains of the dollar index, then we may see support hold at this kind of 79 level, which is this cluster of daily moving averages. Just looking at it from a shorter term level, as you can see, yes, we do seem to have found a little bit of support above that 79 level. Again, that's being this certainly in the short term, we could see a little bit of a bounce higher, maybe towards that 79.40 level, just ahead of 79.50, and we are seeing that in the RSI as well. The daily RSI has turned, so it's we were moving towards oversold levels, not into deep oversold territory, I would say, but as you can see here, we are moving upwards just a little bit. Right, so the other thing I wanted to show you guys is gold. And the reason why, obviously, gold did fantastically well last week after that Obama victory. Remember, the Obama victory, very positive for gold, because he's kind of seen as being positive QE. So let's just take a look. Let's take a look at the daily chart to really see where we are. So we saw that sharp move higher last week. However, we've got that double top there, bit of a tweezer top going on in gold. At 1800, so that's definitely thwarted gains there. But we tried twice. We've got these two long upper wicks on this candlestick chart. The bears have got control around about that 1740 level. That suggests to me right now is where the bulls are willing to let go. They're willing to sell out. So they're willing to buy it around about the 200-day moving average at 1670, but they're selling out at 1740 or just ahead of 1740. They're not, just below 1740. They're not willing to have a sustained rally at this point. And I think that's because, generally, yes, we've seen inflation rise in the UK, but elsewhere inflation is not an issue. In the US, it's not meant to be an issue. In the Eurozone, we've still got too much deflation for it to be an issue there. So that's one of the reasons gold is a good inflation hedge, remember. And when there's not inflation in the world, well, take out the UK, then we're not really seeing, then there's one less reason to buy gold, because you don't really need an inflation hedge. So until we get some sort of more direction in the market, either, remember, I believe that if we get kind of another flare-up of sovereign concerns, or a flare-up or a bout of risk aversion, then we could actually see gold start to trend lower again, go back to that 200-day moving average. I think that if we don't, and we start to see, maybe sentiment pick up, then we could, potentially retest 1750, maybe even try and retest that 1800 level. But for now, in this current environment whereby we don't have those fundamental drivers, I think we may seep lower. I think last week's gains, whereby the dollar really went off on its own, I think it kind of moved too far to the upside. It broke away from other commodities. It broke away from stocks. It broke away from the euro. I think now it's going to suffer, and I think it's going to come off, and we may see a return to that 1700 level, maybe even to 1675, the 200-day moving average. Okay, we've got about kind of just under 10 minutes left. I wouldn't mind taking a question. I also wouldn't mind asking a question actually to you guys, because I'm always kind of asked questions, but it's really interesting. I see such a varied attitude in gold, where gold's going to go. Those of you who might know what or who might be, followed me for a while, or maybe kind of read some of my commentary, I'm a bit wary about gold. I'm a bit wary about when people say, oh, gold's going to be at $2,000 by the end of the year, or gold's going to do fantastically well. I just don't see this as being a great environment for gold. Largely because it's a deflationary environment, because we're all deleveraging both in the US and Europe and the UK. I think inflation is quite superficial. I also think that, if anything, we're probably more likely to range trade. But I realise in some ways that I'm kind of out there on my own about that. So I'm quite interested to hear what you guys think. Do you see gold moving higher between now and the end of the year, or lower? If you could just give me your view quickly, just write it in either your chat or your Q&A box. Just say gold up, gold down, and then that could be quite interesting. Could spring a few talking points. So if you guys could just answer that question, that'd be great. So we've got gold down. Anyone else? Gold up from Jan. Short-term lower, long-term high from Carlos. Ray, gold difficult to trade. Yeah, that's a very, very good point. Well done. I completely agree with that and concur with that completely. I think we've seen, think long-term higher. That's Mohammed. I agree. I think there's people are seeing gold as kind of almost two trades. In the near term, quite difficult to trade. There's not too much of a bullish sentiment out there, but in the long term, gold may go higher because, there could be inflation building in the future. I think that's quite an interesting way. I think gold is very hard to trade in the current environment. And right now, it's becoming, I think some people, that's why we're seeing just short bursts, like we saw that short burst of that uptrend of strength, really, post that Obama victory in the US. Someone's just said a very good point. If the stock market goes down, gold will go down with it. Very good point there. Gold does tend to move, or commodities and stocks do tend to move. Stocks tend to move with a bit of a lag, actually. And actually, on that note, it does bring me up. I do want to just mention, just show you a few stock charts, or chart stocks. Because, we have been very close. As you can see here, currently we are below the 200-day moving average in the FTSE 100 because we've had another lower open today. That's a significant bearish move. If we manage to close below there, so say, for example, we close around about the 75,700 mark today, a very bearish move for a very bearish development there for the FTSE, which suggests we could see further declines, maybe to that 5,600 level, which we were back at, which we last saw in the end of August. But very, very bearish development suggests that we haven't necessarily put in a low right now. So again, just going to Peter's point about stocks and gold, that could also be bearish for gold. So do watch where we are because, as I said, the moves last week were significant across asset classes, not just in the euro, not just in pound, but also in stocks and obviously, which are helping taking the edge off gold. Let's take a quick, sorry. Ooh. This is the S&P 500 in the US as well, really testing, hovering around that 1380 level. Remember, yesterday was the holiday in the US. Stocks were open, but not for very long. Stock markets were open, but not for very long. So volumes are quite thin. So what we may see instead is volumes actually start to come off quite sharply. Volumes come up quite sharply. More people enter the market. And it'll be interesting to see how this pair fares. If it weakens again, if it follows European stock markets and weakens when the US markets open at like 2:30 London time, then we could easily get through 1380. Obviously, then the next level to watch is 1350 and then 1250. But one thing I do want to remind you all is that back a year ago when we had that shutdown of the near shutdown of the US government, and when we had the US Congress squabbling about whether or not to raise the debt ceiling, then we saw the S&P 500 back down to 1100. Let me just show you that here. Here we go. We were round about 1150 back in August last year. Yeah, there you go. And it took quite a long time actually to get higher. We traded sideways for a while before kind of convincingly breaking out in December. Obviously, if we get something similar going on with the fiscal cliff this year in the US, then there could be a long way down for the S&P 500. All right, let's look at this. Right, here we go. So below that level, do watch out for that 1380 level. Now, that's it from me. I'm happy to take one question if someone has one. If someone has a quick question, I'm happy to take it. Okay, I haven't seen any questions, so I guess that means that we've all, hopefully, that I've answered them for you and given you some ideas and just things to look at, ways to look at the market, that type of thing. And I guess as well, maybe we've all had our say about the gold price. So I'm going to leave it there, but thanks so much, everyone, for joining. And please do join us next week for Trading Tuesdays with myself, Kathleen Brooks. Okay, everyone, thanks very much, and good luck trading this week.